The Board of Governors of the Federal Reserve System, the Federal Deposit Insurance Corporation, FDIC, and the Office of the Comptroller of the Currency, OCC, issued a joint statement on Thursday warning about the liquidity risks presented by certain sources of funding from crypto-related entities and some effective practices to manage such risks. The statement reminds banking organizations to apply existing risk management principles. It does not create new risk management principles, they said. Banking organizations are neither prohibited nor discouraged from providing banking services to customers of any specific class or type, as permitted by law or regulation. According to the regulators, certain sources of funding from crypto asset-related entities could potentially pose heightened liquidity risks to banking organizations due to the unpredictability of the scale and timing of deposit inflows and outflows. Examples of such scenarios include deposits placed by an entity that are for the benefit of the entity's customers, and deposits that constitute stablecoin-related reserves. The stability of such deposits may be driven by the behavior of the end customer or crypto asset sector dynamics and not solely by the crypto asset-related entity itself, which is the banking organization's direct counterparty, the regulators warned, adding that market volatility and periods of high stress are things that can affect the stability of depots. More broadly, when a banking organization's deposit funding base is concentrated in crypto asset-related entities that are highly interconnected or share similar risk profiles, deposit fluctuations may also be correlated and liquidity risk, therefore, may be further heightened, the statement said. The Executive Board of the International Monetary Fund, IMF, also released a statement on Thursday saying that cryptocurrencies should not be granted legal tender status. Directors generally agree that crypto assets should not be granted official currency or legal tender status to safeguard monetary sovereignty and stability, the statement said, and called for countries to clarify tax treatment and align their regulations with global standards. This position was formulated following discussions among the 24 directors elected by the IMF member countries after they reviewed a board paper entitled Elements of Effective Policies for Crypto Assets, which they received on February 8. It's no longer news that there have been a crackdown on cryptocurrencies since the incidents of crypto scams that rocked the global market late last year, especially the FTX debacle. Since then, many regulators and policymakers have been looking for ways to pin down the asset class. What this means of crypto would be the context of our video today. Stay tuned, make sure to give us a like, subscribe, and drop your comments below. According to the IMF, while the potential benefits of crypto have not yet materialized, significant risks have emerged, such as macroeconomic risks, which encompass risks to the effectiveness of the monetary policy, capital flow volatility, and fiscal risks. Due to these risks, they believe a comprehensive framework for dealing with cryptocurrencies needs to be agreed upon by member states. The growing adoption of crypto assets in some countries, the extraterritorial nature of crypto assets and its providers, as well as the increasing interlinkages with the financial system, motivate the need for a comprehensive, consistent, and coordinated response, the IMF said. The statement highlighted the view that the widespread adoption of cryptocurrencies has the potential to undermine the effectiveness of the monetary policy, circumvent capital flow management measures, and exacerbate fiscal risks. For these reasons, the directors determined that cryptos should not be granted status as official currency or legal tender. The directors also reached a consensus on the need to develop and apply comprehensive regulations to crypto assets and stressed the need for effective implementation of the FATF standards on AML and CFT. In a nod to the positive potentials of blockchain technology and crypto, the statement added that regulations shouldn't stifle innovation and that governments can benefit from the underlying digital technology. It seems increasingly clear that opposition to cryptocurrency can be considered an official position of the International Monetary Fund, IMF, and we can expect anti-crypto restrictions to become a common condition of its loans to economies in crisis. Last year, Argentina agreed to discourage the use of cryptocurrency as a condition of a $45 billion loan from the IMF. The announcement came less than a year after El Salvador's plan to use Bitcoin as legal tender met with vocal complaints from the IMF ahead of negotiations on a loan with that country. Argentina had been mired in a dire economic crisis for years, with fallout including high inflation. The country also carries huge sovereign debt and has a history of default, making borrowing on conventional markets more difficult. Meanwhile, as laid out by the bloc, Buenos Aires has become a significant center of blockchain and crypto development, substantially because the country's economic and monetary chaos has pushed residents to seek the relative stability and trustworthiness of crypto like Bitcoin. Crypto companies and organizations in the country are still reportedly seeking clarity on what exactly it would mean for their government to discourage the use of crypto. But if Argentines have decided that crypto is a useful way for them to individually cope with economic chaos, Why is the IMF trying to stop them? This IMF austerity program is often imposed on countries amid crisis, making the reforms essentially a form of extortion under compulsion, or what American political commentator Naomi Klein has called the shock doctrine. And while they are advertised as reform measures intended to fix developing economies, they have just as often led to even deeper misery. Klein and others have argued that this makes the IMF fundamentally a stalking horse for global corporations seeking free market reforms, using countries' economic desperation as leverage for imposing policies that allow greater economic extraction. This context suggests why the IMF is so aggressively anti-crypto, because at the highest level, its reason for existence is not to boost developing economies or help the individuals who live within them. The IMF is not a neutral aid organization, but the economic arm of a vast power structure that frequently hides behind the language of uplift and reform. It seeks to draw peripheral or developing nations, African and Latin American countries being a current high priority, into the post-war neoliberal consensus. Crypto threatens that power even if the threat is somewhat distant for now. Mark Weisbrot, writing at the Center for Economic and Policy Research, describes the IMF as a gatekeeper for a creditor's cartel of Western funders, also including the World Bank and the Inter-American Development Bank. But as El Salvador is attempting to demonstrate with its volcano bond, and as donations to Ukraine have recently shown even more dramatically, cryptocurrency is not easy to gatekeep. It seems very plausible that smaller nations such as El Salvador will before long have access to a parallel crypto-based debt and financing market over which the Western order has only tenuous influence. That market will certainly be small relative to the overall global banking system, but even a small financial escape hatch could provide meaningful leverage for pushing back against the IMF and its power-driven agenda. The IMF's actions suggest they foresee that possibility, and they're scared to death of it. iTrust.capital is America's #1 crypto IRA platform. It allows users to buy and sell cryptocurrencies from their individual retirement accounts with low fees, tax-advantaged crypto accounts, and great customer support. iTrust.capital has gotten even bigger, with over $6 billion in transactions and more than 175,000 accounts created. All thanks to its wide range of exciting features, especially the new digital asset staking feature. Users can now stake Polkadot on iTrust.capital for up to 9.5% APY. This is a staking offer from a U.S. regulated network and is completely different from offers from lending platforms like BlockFi and Celsius. Such platforms earn yield via lending rates, a venture that has proven risky and unstable. With iTrust.capital, the yield comes from staking rewards, a risk-averse way to earn a yield on your digital assets holdings. In less than 2 weeks after the beta launch, thousands of clients have staked 25% of the Polkadot on the platform, and it will only get bigger. iTrust.capital currently offers around 30 cryptocurrencies, including Bitcoin, Ether, and Cardano. The retirement account platform plans to add staking support for more cryptocurrencies in the coming months. This is a wholesome offer you do not want to miss, especially while preparing for retirement. It is a long-term investment that can help you achieve your retirement goals much faster while enjoying the vastness of the cryptocurrency industry. Please click the link in the description box to register on iTrust.capital and enjoy all its exciting features. Thanks. What do you think of these new policies by IMF and other financial bodies? Let us know in the comment section below. Also, do not forget to give us a like, subscribe, and turn on notifications for future videos. Thanks for watching.